I want to talk about my gold short put setup, and it's basically it's more viable now because the CVOL, the commodity volatility index, or basically the volatility for gold, is much better now, and the margin requirements are lower for gold than they are for silver. So I do prefer to trade gold over silver, even though they're very correlated currently. So it's either one or the other. So in this case, my first step will be to just wait for a major price pullback, and I think this is what a lot of people are waiting for, and it doesn't just seem to happen. Or if we have a pullback, it recovers very quickly. But obviously not everything can just kind of keep going up and up forever, and it will have to settle down at some point. My second step will be to look at specifically the $4,000 short put strike if the CVOL or volatility is still high. And we'll go over the volatility, the CVOL, and why specifically the $4,000 short strike. Now, step number 3 will be to open closest to 45 days to expiration, probably just 2 contracts per every $100,000 in capital. I'll take profits at 50% of credit and 50% loss target as well of credit. Now, all gold fundamentals are bullish long term, so increased odds for of rate cuts. We have some geopolitical risks ongoing with Venezuela and whatnot, and this is just a big general safe haven demand, which should keep pushing the price of gold up, maybe not at the same speed, but it will keep staying either probably neutral or go up. So first thing is, why would I choose specifically the $4,000 strike? And the main reason is because there's a little support here. So this is what price bounced the previous time when it had a massive pullback. So currently, if we have a pretty big pullback, somewhere within probably, even if we have a pullback of 5%, that's a good enough pullback for me to be entering this short put position. And the short put position is going to be very valuable because volatility is up, and it should stay up even if we have a major pullback. So currently the CVOL, if we look at the 3-month CVOL, currently it's relatively pretty good. Now I'm not counting what happened over here because this was towards the China trade negotiations, so volatility was pretty high. So the situation now is different. So volatility is relatively okay right now. So I'll be okay with opening a position here. And overall, gold has been way more under control as opposed to silver, I guess. Silver has been having massive up day, down days. So not something I really want to be taking a look at. So if we apply the same steps to the option chain, so currently the closest expiration to 45 days is 43 days. I want 45 days because the theta is really speeding up at that point. And I've tried trading like everything from 30 days to expiration to 120 days to expiration. Especially in situations like this, you want theta to be as big as possible on your side, while still having some good out of the money premium and being far out of the money as best you can. So if you look at the 4,000 put strike, so currently there's a bit of a spread here, but it's worth probably about $600, give or take, and I will probably be going for 2 contracts for every $100,000. So if price drops, I can probably expect to collect about total of $2,000 in credit, so 2% of the account, and I'll be profiting just 1%. And times like this it's really hard to profit a lot. Things are just way too crazy, and you have to keep position size small. The swings are insane, but you can still make some good plays if you keep your position size small and you manage correctly. Now, the probability of profit in a situation like this, it's probably going to change if price is going to drop. So it depends, but currently you're looking at about 98.5%. It's still going to be up in the 90s even if the price drops 5%. So we'll see what's going to happen, and if volatility drops, we might still get the same 98.5% probability to make that money. So currently, I just think it doesn't make sense to sell any puts, especially in an all-time high. But a big thing to remember is commodities, they crash upwards, which means volatility goes up as price goes up. So it's the opposite from the S&P, for example. So here, if price goes down, volatility would go down, right? So it's very beneficial to have short puts if you have the right timing of entry. So no, this would have been a perfect timing to enter a short put, but it was just, right before the end of the year, and nobody really wants to be carry any positions from the end of the year into the new year. Speaking strictly as as a money manager, you want to be closing your positions and opening the year pretty fresh, especially because this candle was a lot of profit taking, which will happen again. People will take profits again, and price will have to stabilize and kind of keep going upwards and creeping upwards, but not at the same speed as obviously we see today. 2.5%. Silver went up a crazy amount to a new all-time high, 7.25%. Right. So I still have a plan in place for silver as well. So depending which one of them is gonna pull back enough, and what kind of volatility we will have, and what kind of premium we get, I prefer gold over silver because of the margin requirements, and it's just a more stable product, especially given these crazy swings in silver. Thank you again. If you have any questions, let me know. Keep you posted of any and every move I make. I'll keep you posted of what happened with corn. I was planning to open a position after the report today on Monday, January 12th, and the price just dropped almost 5.5% towards the end of the day for corn. So my entire short strangle idea kind of went to garbage. But it is what it is. You have to look for those good setups. If they end up not materializing, it is what it is, and we'll keep looking for other opportunities. So thank you again. If you have any questions, let me know, and I will catch you in the next one.